Before we begin, a quick and important disclaimer. The following content is provided strictly for educational and entertainment purposes. It does not constitute legal, financial, or tax advice. Divorce proceedings and the division of retirement assets, such as 401k plans, are governed by complex state and federal laws that vary significantly depending on your jurisdiction and specific circumstances. You should not act upon this information without consulting a qualified attorney or a certified financial professional. Always conduct your own due diligence before making significant life or financial decisions. The American dream used to be defined by a white picket fence, 2 kids, and a steady climb toward a shared retirement funded by a robust 401k. But in the current era, that dream is undergoing a radical, and for many, a painful transformation. Imagine working for 30 years, meticulously contributing every paycheck, watching your compound interest grow into a 7-figure nest egg, only to realize that a single signature on a divorce decree could instantly slash that balance by 50%. We are currently witnessing a historic phenomenon known as the 401k divorce. As cultural shifts redefine the duration and purpose of marriage, the very vehicles designed to secure our future are becoming the primary battlegrounds in the legal system. In the last decade alone, the rise of the silver divorce, couples over the age of 50 ending long-term marriages, has sent shockwaves through the financial sector. These aren't just breakups. They are total liquidations of decades of labor and compound growth. This video is your deep dive masterclass into the mechanics of this shift. By the time we finish this 10-part series, you will understand exactly how the legal system treats your retirement accounts, the hidden traps of the Qualified Domestic Relations Order, or QDRO, and the cultural reasons why more Americans than ever are choosing personal autonomy over financial stability. This is the guide to surviving the modern intersection of love and compounding interest. To understand the 401k divorce, we must first look at the cultural tectonic plates shifting beneath our feet. For the better part of the 20th century, marriage was viewed through the lens of institutional stability. It was an economic partnership designed for the long haul, where retirement was a joint reward for a lifetime of shared sacrifice. However, the 21st century has ushered in the era of expressive individualism. People are no longer staying in marriages simply for the sake of the institution. They are seeking personal fulfillment and self-actualization. When that fulfillment is missing, they are increasingly willing to walk away, even if it means jeopardizing their financial security. This cultural shift has created a massive collision with the way American retirement is structured. Unlike the pensions of the past, which were often managed by employers and provided a set monthly benefit, the 401k is an individual account. Feels personal. It has your name on it. You chose the funds. You felt the sting of the market dips and the thrill of the bull runs. This psychological ownership makes the division of these assets during a divorce particularly jarring. When a court views that account as marital property, it creates a visceral sense of loss that can lead to high-conflict litigation. Consider a case study of a typical American couple. Let's call them Mark and Sarah. Mark has worked in corporate tech for 25 years, building a 401k balance of $1.2 million. Sarah spent a significant portion of those years managing the household and working part-time. In the eyes of the law in many states, that $1.2 million isn't Mark's retirement. It is a marital asset. If they divorce, the starting point for negotiation is often a 50-50 split. For Mark, this means his projected retirement age might suddenly jump from 62 to 72. For Sarah, it means managing a lump sum of $600,000 that must now last the rest of her life without the benefit of Mark's ongoing high-income contributions. The complexity deepens when you realize that a 401k is not just a pile of cash. It is a tax-advantaged vehicle. You cannot simply write a check for half the balance. If you do, you trigger immediate income taxes, and if you are under the age of 59 and a half, a 10% early withdrawal penalty. This is where the historical trend of the QDRO comes into play. A Qualified Domestic Relations Order is a specialized legal instruction that allows for the tax-free transfer of retirement funds from one spouse to another during a divorce. However, the process of drafting a QDRO is a minefield of administrative hurdles. One wrong word in the document, and the plan administrator can reject it, leaving both parties in a state of financial limbo for months or even years. Furthermore, we have to address the impact of inflation and market volatility on these splits. If a couple agrees to a settlement in October, but the market drops 15% by the time the 401k is actually divided in February, who bears that loss? These are the granular details that can turn an amicable separation into a decade-long financial recovery process. We are seeing a trend where divorce attorneys are now required to be as much financial analysts as they are legal advocates. The data suggests that the financial recovery period for a 401k divorce is significantly longer than for other types of debt or asset loss. When you lose half of a retirement account at age 30, you have time to let the market heal the wound. When you lose half at age 55, the math changes. You have lost the most valuable asset in investing time. You are essentially trying to build a 30-year portfolio in the final 10-year sprint of your career. This has led to a surge in the working elderly population, not because they want to stay active, but because the cultural shift toward late-life divorce has made retirement a moving target. We also need to examine the psychological toll. The 401k often represents a person's sense of safety. In a world where Social Security is frequently debated and pensions are nearly extinct, that account balance is the only thing standing between a comfortable old age and a precarious one. When that is halved, it triggers a survival response that can make rational negotiation nearly impossible. This is why we see couples spending $50,000 in legal fees to fight over an extra $20,000 in a retirement account. The math doesn't add up, but the fear does. Throughout this series, we are going to break down the specific strategies used to navigate these waters. We will look at how prenuptial and postnuptial agreements are being utilized not just by the wealthy, but by middle-class professionals looking to ring-fence their retirement contributions. We will explore the concept of offsetting assets, where one spouse keeps the house while the other keeps the 401k, and the massive tax implications of those decisions. A $500,000 house and a $500,000 401k are not equal. The house is bought with after-tax dollars. The 401k is a future tax bill waiting to happen. The American cultural landscape is changing. The way we view commitment, longevity, and personal happiness is evolving, and the 401k is the ultimate collateral. Whether you are currently married, considering divorce, or just starting your career, understanding the mechanics of the 401k divorce is no longer optional. It is a critical component of modern financial literacy. We are moving away from a world of shared outcomes into a world of individual risk management. This deep dive is designed to ensure that no matter what happens in your personal life, your financial future remains intact. Let's get into the step-by-step reality of how the legal system views your hard-earned savings. To understand how the legal system views your 401k, we have to look at the concept of marital property versus separate property. In the United States in 2026, the distinction between what is yours and what is ours is often the most expensive debate in a courtroom. Imagine a software engineer named David. David started his career in 2010 and began diligently contributing to his 401k. By the time he married his spouse Maria in 2018, his account had a balance of $200,000. Fast forward to today, 2026, and the couple is filing for divorce. The account has grown to $850,000. David might assume that since he started the account and his name is on the statement, the bulk of that money belongs to him. However, the legal reality is far more complex. In the eyes of the court, that initial $200,000 is likely separate property, but every dollar contributed during the 8 years of marriage, along with the proportional growth and market appreciation of the entire account, is considered marital property. This creates a forensic accounting nightmare. You aren't just splitting a pie. You are trying to figure out which ingredients were put in the bowl before the marriage, and how much those specific ingredients rose during the baking process compared to the ingredients added after the wedding. Historical trends show that courts increasingly lean toward a broad definition of marital assets to ensure equity, particularly in long-term marriages where one spouse may have sacrificed their own career growth to support the household. This is the community property versus equitable distribution divide. If you live in a community property state like California, Arizona, or Texas, the law generally dictates a strict 50-50 split of all assets acquired during the marriage. In equitable distribution states, which make up the majority of the U.S., the court has more discretion. They look at factors like the length of the marriage, the age and health of each spouse, and their future earning potential. But even in these states, the 401k is often the first thing on the chopping block because it is a liquid adjacent asset with a clear dollar value. Let's dive into the step-by-step reality of the valuation process. The first step is the date of separation. This is a critical piece of data that can fluctuate the value of your settlement by tens of thousands of dollars. If David and Maria separated in January 2026 when the market was at an all-time high, but the legal filing didn't happen until a market correction in June, The court has to decide which valuation date to use. Use the wrong date, and one spouse might be paying out a percentage of a balance that no longer exists in reality. Case studies from recent years highlight the danger of the passive growth trap. Even if you stop contributing to your 401k the day you move out, the marital portion of that account continues to earn dividends and capital gains until the day the divorce is finalized. In a bull market, this means the amount you owe your ex-spouse is a moving target that grows every single day, the lawyers continue to argue. This is why many high-net-worth individuals in 2026 are pushing for bifurcated divorces, where the marriage is legally ended quickly, while the asset division is hammered out later, though this carries its own set of tax risks. Now let's talk about the specific instrument used to move this money. The Qualified Domestic Relations Order, or QDRO. Most people think they can just transfer funds from one 401k to another like a standard bank transfer. That is a massive misconception. A 401k is governed by ERISA, a federal law that protects retirement plans. A standard divorce decree issued by a state court has no power over a 401k plan administrator. To get the money moved, you need a separate legal document, the QDRO, which must be approved by both the court and the specific plan administrator at the employer. Imagine the administrative friction here. Each company, whether it's Amazon, Google, or a local manufacturing firm, has its own specific requirements for what a QDRO must look like. If your attorney uses a generic template and misses a single clause regarding survivor benefits or cost of living adjustments, the plan administrator will reject it. We have seen historical trends where it takes 3 or 4 attempts over 18 months just to get a QDRO approved. During that time, the person who is supposed to receive the money has no access to it, and the person who owns the account is often barred from making any changes to their investment allocations. You are essentially frozen in your financial tracks. There is also the hidden cost of the QDRO itself. It is not uncommon for a specialized QDRO attorney to charge between $1,000 and $3,000 just to draft the document, and the 401k plan administrator may charge an administrative fee ranging from $500 to $1,500 to process it. These fees are often deducted directly from the account balance, eroding the very nest egg you are fighting over. But what happens if you don't want to split the 401k? This brings us to the strategy of the asset offset. In many American divorces in 2026, one spouse wants to stay in the family home, perhaps for the sake of the children's school district. If the home has $400,000 in equity and the 401k has a balance of $400,000, it seems like a clean swap. Maria keeps the house. David keeps the retirement. On paper, they both walk away with $400,000. But this is a mathematical illusion that has devastated the financial futures of thousands of Americans. The house is an after-tax asset. If Maria sells it later, she might have a primary residence exclusion on the capital gains. The 401k, however, is a pre-tax asset. When David goes to withdraw that $400,000 in retirement, he will have to pay federal and state income taxes on every single penny. Depending on his tax bracket in 2026 and beyond, that $400,000 account might actually only be worth $280,000 in real-world spending power. In this scenario, David just lost $120,000 in a trade that looked equal on a spreadsheet. Furthermore, we have to consider the liquidity crisis. You can't eat your house, and you can't easily spend your 401k before age 59.5 without penalties. We are seeing a cultural shift where divorced individuals find themselves house-rich and cash-poor, or retirement-rich and lifestyle-poor. This lack of balance is a direct result of failing to understand the tax-adjusted value of marital assets. As we look at the data from the mid-2020s, another factor is emerging: the rise of the loan balance. Many Americans borrow against their 401k to fund down payments or emergency expenses. If David has a $50,000 loan against his 401k when the divorce begins, that loan is often treated as a marital debt. If the loan isn't paid back, it's treated as a distribution, triggering taxes and penalties. Who is responsible for that tax bill? If the money was used to renovate the kitchen in the house Maria is keeping, should David be the one to suffer the 401k penalty? These are the friction points that turn a simple split into a multi-year legal battle. The reality of the 401k divorce is that the law views these accounts as a collective piggy bank, regardless of whose sweat and time went into filling it. But the legal division is only half the story. The way you handle the tax implications and the timing of the transfer will determine if you retire in comfort or if you are forced to rejoin the workforce at 70. But there is an even darker side to this. What happens when one spouse tries to hide assets? Or what happens when the market crashes in the middle of your QDRO approval? And perhaps most importantly, what is the one specific clause you must include in your divorce decree to prevent your ex-spouse from accidentally inheriting your 401k, even after the divorce is finalized? We are going to dive into the nightmare scenarios and the forensic tactics used to uncover hidden retirement funds in the next part. What if you discovered that your spouse had a secret second 401k from a previous employer that they conveniently forgot to disclose? Or what if the very company you work for goes through a merger while your QDRO is pending, effectively vanishing your account into a new system? The stakes are about to get much higher. The nightmare of the hidden asset is not just a plot point for a legal thriller. In 2026, it is a high-stakes reality fueled by the complexity of the modern American gig economy and fragmented career paths. We must address the phenomenon of the forgotten or concealed 401k. Historically, an employee might stay with one company for 30 years, making their retirement trail easy to follow. Today, the average American worker changes jobs every 4 years. This creates a breadcrumb trail of dormant 401k accounts. Imagine a scenario involving a spouse named Robert. Robert has been married to Jennifer for 15 years. During their marriage, Robert worked for 4 different tech startups. While he disclosed his current 401k with his primary employer, he conveniently neglected to mention 2 smaller accounts from 2018 and 2021 that had been sitting in target date funds, quietly compounding. In a divorce proceeding, these are not just oversights. They are potential legal landmines. Forensic accounting has become a standard requirement in 2026 divorces because of this exact issue. A forensic accountant doesn't just look at current bank statements. They perform a deep dive into tax returns from the last decade, looking for Form 1099, are filings or small dividend payments that signal the existence of an undisclosed retirement vehicle. If Jennifer's legal team discovers these accounts, the potential outcomes for Robert go beyond just splitting the money. In many jurisdictions, a court may view the intentional concealment of assets as a breach of fiduciary duty to the spouse, which could result in the court awarding Jennifer a significantly higher percentage of the discovered funds as a penalty. The complexity intensifies when we look at the logistics of tracing these funds. Step 1 is the discovery phase, where both parties are required to provide a comprehensive list of all financial interests. However, the system relies heavily on honesty, which is often in short supply during a contentious split. This is why it is crucial to look at historical payroll records. If a pay stub from 5 years ago shows a line item for a 401k contribution, but no current account exists, that money had to go somewhere. It was either rolled over into an IRA, which should be disclosed, or it is still sitting with a former employer's plan administrator. Now, consider the systemic risks of corporate volatility. In 2026, the pace of corporate mergers and acquisitions is relentless. Imagine if Robert's employer is acquired by a global conglomerate right in the middle of the divorce. The 401k plan is frozen. The plan administrator changes from a boutique firm to a massive institutional provider. Suddenly, the account number David provided in his initial disclosures is invalid. The funds are moved into new investment tiers. If a QDRO was drafted based on the old plan's rules, it is now effectively a piece of scrap paper. The legal team must start over, communicating with a new human resources department that has no record of the pending litigation. This administrative black hole can swallow months of time and thousands of dollars in additional legal fees. We must also discuss the technicality of the beneficiary designation, which is perhaps the most dangerous trap in the entire 401k divorce process. Most people assume that once a judge signs a divorce decree, their ex-spouse is automatically removed from their retirement accounts. This is a catastrophic misconception. Under federal ERISA law, the beneficiary designation on file with the plan administrator often overrides the divorce decree. There are historical trends where an individual dies years after a divorce, having never updated their 401k beneficiary form. Even if the divorce decree explicitly stated that the ex-spouse waived all rights to the retirement account, the plan administrator may be legally obligated to pay the entire balance to the ex-spouse because their name was still on the designation form. In 2026, the step-by-step process to prevent this involves more than just a signature. It requires a formal change of beneficiary form submitted and confirmed by the plan administrator immediately following the entry of a final judgment. But there is a catch. During the divorce proceedings, many states have automatic temporary restraining orders that prevent you from changing beneficiaries until the case is closed. This means there is a window of extreme vulnerability where, If you were to pass away before the ink is dry on the final papers, your soon-to-be ex could inherit everything, leaving your children or other heirs with nothing. Let's expand on the concept of the 401k loan during a divorce. Imagine if Jennifer took out a $40,000 loan from her 401k 2 years ago to pay for a family medical emergency or a child's tuition. In 2026, that loan is technically an asset of the plan, but it is also a liability for the participant. If the 401k is being split 50-50, how is the loan handled? If the court orders a split of the gross balance, Jennifer might be forced to pay back the loan immediately to facilitate the transfer. If she cannot afford to pay it back, the loan is treated as a distribution. This triggers an immediate tax bill and a 10% penalty if she is under 59.5. Suddenly, the act of splitting the account has created a $15,000 tax liability that neither party planned for. Case studies show that the most successful resolutions in these scenarios involve specific language in the settlement agreement that allocates the tax responsibility of 401k loans. Without this, the spouse who owns the account is often left holding the bag for a debt that was used for mutual benefit. This is the granular level of detail that a standard divorce attorney might miss, but a specialized financial advocate will prioritize. Furthermore, we are seeing a shift in how 2026 courts handle market fluctuations during the period between the settlement agreement and the actual transfer of funds. If the market experiences a significant downturn, a fixed dollar award can be devastating. For example, if Robert agrees to give Jennifer $200,000 from his $400,000 401k, he is assuming a 50% split. But if the market drops 20% before the QDRO is processed, Robert's total balance falls to $320,000. If the legal document specifies a fixed amount of $200,000, Jennifer still gets her full amount, leaving Robert with only $120,000. He has effectively taken a 65% loss while she took zero. To avoid this, modern settlements are increasingly using percentage-based awards or earnings and losses clauses, which ensure that both parties share in the market's movement until the day of the actual segregation of assets. The psychological warfare of the 401k divorce cannot be ignored either. Because these accounts are often the largest single source of liquid wealth, they are used as leverage in other areas of negotiation. A spouse might offer to take less of the 401k in exchange for a higher alimony payment, or vice versa. But this is comparing apples to oranges. Alimony is typically taxable income to the receiver and a tax deduction for the payer, depending on the date of the original agreement and evolving tax laws. Whereas a 401k transfer via QDRO is a non-taxable event at the time of transfer, but carries a massive future tax burden. Failing to calculate the net after-tax value of these trade-offs is a primary reason why many people find themselves in financial distress 3 to 5 years after their divorce is finalized. As we move forward, we have to look at the global perspective. With more Americans working for international firms, what happens when your 401k is tied to a domestic subsidiary of a foreign company with different vesting schedules and legal protections? And even more pressing, what happens when the 401k isn't the only retirement asset? In the next part, we are going to look at the collision between 401ks and the resurgence of the modern pension, and why certain professions like teachers, firefighters, and federal employees face a completely different set of rules that can make a 401k split look like child's play. What if your spouse's retirement isn't just a balance on a screen, but a guaranteed lifetime stream of income that is shielded by state laws? The tactics change and the math becomes even more aggressive. We are entering the territory of the valuation of future promises, and the numbers are staggering. The valuation of future promises, specifically defined benefit plans or pensions, introduces a level of mathematical intensity that far exceeds the relatively simple arithmetic of a 401k split. While a 401k is a defined contribution plan with a clear, real-time balance, a pension is a promise of future monthly payments based on a formula involving years of service and final average salary. In the United States in 2026, we are seeing a fascinating resurgence in the importance of these plans, particularly among government employees, teachers, and public safety officers. If you or your spouse hold one of these plans, the 401k divorce process becomes significantly more complex because you are no longer just looking at a statement, you are looking at an actuarial projection. Imagine a scenario involving a high school principal named Linda and her spouse, Kevin, a freelance graphic designer. Linda has been in the state teacher's retirement system for 22 years. She is 10 years away from retirement. Her pension doesn't have a cash-out value of $1 million today. But when she retires in 2036, she might receive $6,000 a month for the rest of her life. If she lives until 90, that is a total payout of over $2 million. The central question for the court in 2026 is, how much of that future $2 million belongs to Kevin today? This is where we encounter the use of the coverture fraction, a formula used by courts to determine the marital portion of a future pension. The numerator of the fraction is the number of years the employee worked while married, and the denominator is the total number of years of service. If Linda and Kevin were married for 20 of those 22 years, the coverture fraction would be 20 over 22. However, because Linda is still working, the denominator is a moving target. Every year she continues to work after the divorce reduces the marital percentage of the ultimate payout. This creates a massive incentive for the non-employee spouse, Kevin, to push for an immediate present value buyout, rather than waiting for a share of the future payments. Calculating the present value of a pension is one of the most contentious steps in a modern divorce. It requires a forensic actuary to make assumptions about future interest rates, inflation, and even Linda's life expectancy, based on 2026 mortality tables. If the actuary uses a low discount rate, the present value of the pension appears much higher, which benefits Kevin. If they use a high discount rate, the value appears lower, benefiting Linda. A shift of just 1% in the assumed interest rate can swing the valuation of a pension by $100,000 or more. Historical trends in 2026 show that these valuations are becoming a battle of the experts, with each side hiring their own actuary to produce conflicting reports. Now let's add the 401k back into the mix. Often, a couple will attempt to trade the 401k for the pension. Kevin might say, "I will take the entire $400,000 in the 401k if you keep your entire pension." On the surface, this looks like a clean break. But this is where the risk of the unknown becomes a factor. If Linda passes away shortly after retirement, her pension payments may stop entirely, or drop significantly for her heirs. The 401k Kevin took, however, is a hard asset that he can pass down to his children. In 2026, we are seeing more individuals choose the bird in the hand, the 401k, over the future stream of income, especially as concerns over the long-term solvency of certain state pension funds continue to linger in the public consciousness. We also have to address the unique case of federal employees and the Thrift Savings Plan, or TSP. The TSP is essentially the government's version of a 401k, but it is governed by its own set of rules under the federal employees' retirement system. Unlike a private sector 401k, which uses a QDRO, the TSP requires a Retirement Benefits Court Order, or RBCO. The language required for an RBCO is incredibly rigid. If the order doesn't explicitly mention things like catch-up contributions or specific loan treatment, the federal government will reject it. We have seen case studies where veterans or federal agents lose out on years of growth because their divorce decree used private sector terminology that the federal government refused to recognize. Furthermore, consider the impact of the Social Security offset. In some states, if one spouse has a pension from a job where they did not pay into Social Security, like many teachers or police officers, the court may perform a calculation to simulate what their Social Security benefit would have been, and then offset the other spouse's share of the pension. This is done to ensure that the spouse who worked in the private sector and paid into Social Security isn't unfairly penalized. In 2026, as Social Security reform remains a hot-button issue, these offsets are becoming more difficult to calculate. If the age for full Social Security benefits is pushed back, the present value math for the pension offset must also change, leading to further legal gridlock. Step by step, if you are navigating a divorce involving both a 401k and a pension, the process usually looks like this. First, you must obtain a benefit statement that shows the accrued benefit as of the date of marriage and the date of separation. Second, you must decide between a deferred distribution, where the ex-spouse gets a check from the pension plan years later, or an immediate offset, where they get a larger share of other assets like the house or 401k now. Third, you must ensure that survivor benefits are addressed. This is a critical point. If Linda dies before she retires, and the divorce decree didn't specifically name Kevin as a surviving spouse for the pre-retirement death benefit, he may get zero, despite being married to her for 2 decades. In 2026, we are also seeing a rise in what is called the double dip. This occurs when a spouse's pension is valued as an asset for the property division, and then the actual monthly income from that same pension is later counted as income for the purposes of calculating alimony. Many states have passed laws to prevent this, but the overlap remains a gray area that high-conflict litigants often exploit. It requires a precise legal strategy to ensure that the same dollar isn't being divided twice. Another cultural shift impacting 401k and pension splits is the rise of the gig economy among older Americans. In 2026, it is common for someone like Linda to retire from teaching, but then immediately start a consulting business or a second career in the private sector. If her divorce settlement was based on the idea that she would be living on a fixed income, but she suddenly doubles her earnings, Kevin might try to return to court to modify the alimony or the asset split. This leads to a state of perpetual litigation that can drain the very retirement funds both parties are trying to protect. The complexity of these domestic relations orders cannot be overstated. We have moved far beyond a world where you just split everything down the middle. In 2026, your retirement is a multi-layered cake of 401ks, IRAs, TSPs, and pensions, each with its own tax code, its own administrator, and its own set of federal or state laws. If you treat them all the same, you are almost certainly leaving money on the table or walking into a tax trap. But what happens when the 401k isn't just in the United States? As more Americans work remotely for international firms or hold assets in foreign retirement schemes, the 401k divorce is going global. How do you issue a QDRO to a company based in Singapore or London? And how do you handle the currency fluctuations that can happen during the 18 months it takes to finalize a high-stakes divorce? We are about to cross borders into the world of international asset division and the high-tech ways people are trying to hide their retirement in the digital age. What if your spouse's 401k isn't just in mutual funds, but is heavily invested in company stock that is about to go through a massive IPO? Or what if they have been using their self-directed 401k to buy alternative assets like real estate or even digital currency? The game is changing, and the rules of 1990 no longer apply to the wealth of 2026. The evolution of the self-directed 401k, or SDBA, has fundamentally altered the landscape of asset division in 2026. While traditional 401k plans limit participants to a curated list of mutual funds or target date funds, a self-directed option allows the account holder to invest in almost anything: individual stocks, private equity, physical real estate, and even digital assets. This creates a massive transparency gap during a divorce. Imagine a character named Michael, a senior executive who has spent the last decade funneling his 401k contributions into a self-directed window. Instead of holding standard index funds, Michael's 401k owns a 20% stake in a local commercial warehouse and a significant amount of a volatile cryptocurrency that he bought back in 2022. When Michael's spouse, Sarah, files for divorce in 2026, the standard 401k statement she sees might only show a total valuation based on the last appraisal of the warehouse and the current market price of the digital coins. However, the valuation of the warehouse is 2 years old. In the current 2026 real estate market, that warehouse might be worth double what is on the statement, or it might be a liability due to changing zoning laws. Because the asset is held within the 401k wrapper, Sarah's legal team cannot simply look at a Zillow estimate. They have to hire a commercial appraiser who understands the specific ERISA rules governing assets held within retirement plans. This is a step-by-step process that involves gaining access to the plan's underlying trust documents, which plan administrators are often hesitant to release without a specific subpoena. Historical trends show that the more complex the asset inside the 401k, the more likely the divorce will descend into a battle of valuations. If Michael's digital currency holdings have fluctuated by 30% during the 6 months of the divorce proceedings, a fixed percentage split becomes a nightmare to execute. If Sarah is awarded 50% of the 401k, does she get 50% of the coins, or 50% of their value at the time of the filing? If the plan administrator doesn't support the transfer of digital assets to a non-participant, Michael might be forced to liquidate the coins to pay Sarah her share. This liquidation triggers transaction fees and potentially locks in a loss that neither party wanted. Case studies from 2025 and 2026 highlight that many self-directed 401k plans are not equipped to handle the segregation of alternative assets, leading to situations where the only solution is for one spouse to buy out the other with outside cash that many couples simply do not have. Now let's consider the impact of net unrealized appreciation, or NUA. This is a specific tax strategy often used when a 401k contains a significant amount of company stock. If Michael works for a major U.S. corporation like Amazon or Tesla and has held company stock in his 401k for 20 years, the stock has likely appreciated significantly. Under NUA rules, if he takes a lump sum distribution of the stock, he only pays ordinary income tax on the cost basis, the price at the time of purchase, while the appreciation is taxed at the much lower long-term capital gains rate. In a 2026 divorce, the decision of whether to utilize NUA can be a million-dollar question. If Sarah receives half of the 401k via standard QDRO, she might lose the ability to use the NUA strategy on her portion, depending on how the plan is structured and how the transfer is executed. If Michael keeps the stock and gives Sarah other assets, he is essentially keeping a massive future tax break for himself. Sarah's legal team must perform a tax sensitivity analysis to determine the true value of those shares. A $500,000 block of stock with a low cost basis is worth significantly more than a $500,000 block of stock with a high cost basis because the future tax liability is lower. Failing to account for NUA is one of the most common ways that spouses in high-stakes divorces are inadvertently shortchanged. Beyond the domestic complexity, we are seeing the rise of the international 401k conflict. In 2026, the U.S. workforce is more mobile than ever. Imagine Sarah is a dual citizen who worked in London for 5 years before moving to New York to marry Michael. She has a UK-based pension or a self-invested personal pension, known as a SIPP. While the U.S. court has jurisdiction over the couple, it has zero authority over a UK pension provider. A US-issued QDRO is essentially meaningless in the United Kingdom. To divide Sarah's UK assets, the couple might need to engage in a mirror order process, which involves hiring solicitors in London to draft a pension sharing order that complies with UK law, while reflecting the intent of the US divorce decree. The costs of these cross-border maneuvers are staggering. You are paying 2 sets of lawyers, 2 sets of forensic accountants, and dealing with the constant fluctuation of the British pound against the US dollar. Historical trends indicate that many couples choose to simply offset these foreign assets. Michael keeps his entire US 401k, and Sarah keeps her entire UK SIPP. But in 2026, with the US dollar experiencing volatility against global currencies, what looked like an even trade in March might be a 20% disparity by September. This creates a high-pressure environment where the timing of the final decree can lead to one spouse feeling significantly cheated by the math of global economics. Step by step, the discovery of these international and alternative assets requires a level of diligence that goes beyond traditional legal methods. In 2026, forensic teams are using blockchain analytics to track 401k-funded digital asset purchases and international wire transfers that may signal the existence of offshore retirement vehicles. If a spouse has been using their 401k to fund a self-directed IRA that owns property in a foreign country, the legal complexity scales exponentially. The court must decide if it will treat the foreign property as a marital asset and how to enforce a sale or a buyout if the property is subject to the laws of a non-US jurisdiction. We also have to address the psychological shift in how 401ks are perceived in the age of the side hustle. In 2026, many Americans have both a corporate 401k and a solo 401k for their 1099 consulting work. This creates a shell game of contributions. A spouse might overcontribute to their solo 401k in the months leading up to a divorce filing, effectively hiding cash in a tax-advantaged vehicle that they hope will be overlooked during the discovery process. However, because 401k contributions are capped by the IRS on a per-person basis, not a per-plan basis, an overcontribution is a red flag that forensic accountants are trained to spot instantly. As we look at these case studies, a pattern emerges. The more a spouse attempts to customize or complicate their retirement strategy, the more vulnerable they become during a divorce. The very tools designed to maximize wealth, self-direction, NUA strategies, and international diversification become the primary points of friction that can delay a divorce for years. In the world of 2026, a 401k is no longer a passive savings account. It is a complex financial entity that requires a sophisticated defense and an even more sophisticated offense during a marital split. But even with all this complexity, there is one factor that can override everything: the behavior of the participants themselves. What happens when a spouse decides to intentionally tank the value of their 401k out of spite? Or what happens when a plan administrator makes a catastrophic error during the QDRO process that wipes out years of gains? The legal and financial safeguards are supposed to protect you. But as we will see in the next part, the human element can be the most destructive force of all. What if your spouse decides to take out a maximum 401k loan and spend the money on non-traceable items just days before filing? And how does the law handle the dissipation of assets when the money was technically yours to begin with? We are moving into the realm of financial misconduct and the aggressive tactics used to claw back stolen retirement futures. The concept of financial misconduct, often referred to in legal circles as the dissipation of marital assets, takes on a particularly sharp edge when applied to 401k accounts in 2026. Because these accounts represent years of deferred gratification, seeing them drained in a matter of weeks by a vengeful or desperate spouse is a unique form of financial trauma. Imagine a character named James. James has spent 15 years as a mid-level manager at a logistics firm, accumulating a 401k balance of $350,000. When the marriage begins to fail, James realizes that in his state, his spouse, Emily, is likely entitled to half. Out of a mixture of spite and panic, James decides to take the maximum allowable loan from his 401k, $50,000, and spends it on high-end luxury items, expensive travel, and cash gifts to relatives, all while claiming the money was spent on joint marital debts. In the legal framework of 2026, this is a classic case of dissipation. However, proving it requires a meticulous step-by-step forensic reconstruction. The court does not automatically assume guilt. Emily's legal team must first establish that the marriage was undergoing an irreconcilable breakdown at the time the funds were spent. Then, they must prove that the expenditure did not benefit the marriage. If James can argue that the $50,000 was used to pay down a joint credit card or fix the roof of the marital home, the court may view it as a legitimate use of funds. But if the evidence shows the money went toward a solo trip to Las Vegas or a collection of vintage watches, the court can implement a clawback mechanism. The clawback isn't a physical reversal of the spending. You cannot easily force a casino or a jeweler to return the money. Instead, the court uses the power of offsetting. If the total marital pot is $600,000, and James dissipated $50,000, the court may calculate the split as if that $50,000 still existed. In this scenario, Emily might receive $325,000 of the remaining assets, while James only receives $225,000. He essentially has his share reduced by the full amount of the wasted funds. Historical trends in 2026 show that judges are becoming increasingly less tolerant of these bad faith maneuvers, often applying additional interest or legal fee penalties to the spouse who attempted to hide or waste the retirement nest egg. Another aggressive tactic we see in 2026 is the strategic 401k contribution freeze. Imagine if James, knowing a divorce filing is imminent, suddenly stops all his elective deferrals and cancels his employer's 5% match. Over the course of a 2-year litigated divorce, that could mean $30,000 to $40,000 in lost contributions and potential market growth that Emily would have shared in. While this isn't technically illegal, as individuals generally have the right to manage their own income, it is often viewed as a red flag by the court. Some aggressive attorneys are now pushing for marital waste claims based not on what was spent, but on the wealth that was intentionally not created during the separation period. This leads us to the critical issue of 401k plan administrator errors. In the hyperdigital landscape of 2026, many HR functions are outsourced to third-party tech platforms. When a QDRO is processed, it isn't always a human being moving the money, it is often an automated script. There have been case studies where a plan administrator misinterpreted the language of a court order and liquidated a spouse's entire position during a market low to facilitate a transfer, rather than transferring the shares in kind. If the market rebounds 20% the following month, the receiving spouse has lost out on a massive gain due to an administrative blunder. In these instances, the question of liability becomes a three-way battle between the ex-spouses and the financial institution. ERISA laws provide some protection to plan administrators as long as they act in accordance with the plan documents, but that doesn't help the person who just lost $80,000 in potential growth. We are seeing a trend where divorce settlements now include indemnity clauses, stating that if the plan administrator makes an error, the spouse who initiated the transfer must cooperate in legal action to recover the funds. This is a level of protection that was rarely seen a decade ago but is essential in 2026. Now, consider the high-stakes scenario of the self-employed participant. Case studies of 2026 small business owners show a disturbing trend. The use of the solo 401k as a personal piggy bank to bypass divorce settlements. Because the owner is also the plan administrator, they have a level of control that a corporate employee does not. They might attempt to backdate loan documents or change investment valuations within the plan to make the account look less valuable than it truly is. Forensic accountants in 2026 are countering this by demanding the underlying brokerage statements and tax filings for the plan itself, not just the summary reports provided by the owner. If the business owner is found to have manipulated the 401k data, They face not only civil penalties in the divorce but potential federal investigations for ERISA violations. Step by step, if you suspect your spouse is engaging in financial misconduct with their 401k, the first move is an immediate request for a temporary restraining order on the account. This freezes all loans, withdrawals, and changes to beneficiary designations. The second move is a demand for at least 5 years of historical statements. You are looking for patterns, sudden drops in value that don't correlate with market indices, or unexplained loans that were never repaid. In 2026, data visualization tools allow legal teams to overlay a 401k's performance against the S&P 500. Any significant deviation is a signal to dig deeper. The cultural shift here is one of heightened suspicion. In previous generations, the 401k was seen as a boring static account. In 2026, it is recognized as a dynamic, maneuverable asset. This change in perception has made the 401k divorce a theater of financial war. We see spouses who, rather than wasting the money, attempt to overcomplicate the investments within the 401k to make it unsplittable. They might move funds into illiquid private equity tranches or specialized real estate investment trusts that have 10-year lockup periods. By doing this, they are effectively telling their ex-spouse, "You can have half, but you can't touch it until 2035. The legal response to this is the use of the constructive trust. A judge can rule that even if the money cannot be moved now, the spouse who holds the account does so as a trustee for the other person's half. This means any dividends, growth, or voting rights associated with that half must be accounted for and turned over the moment the asset becomes liquid. It creates a permanent financial link between ex-spouses that can last for decades, a prospect that often convinces the parties to find a more immediate, cash-based settlement. We are also seeing a rise in the use of AI-driven legal tools to predict the outcomes of these misconduct claims. In 2026, attorneys can input the specifics of a dissipation case into a database of thousands of prior rulings to see how a particular judge is likely to rule. This data-driven approach is forcing more settlements, as the spouse who spent the 401k money on a midlife crisis realizes that the probability of a court-ordered clawback is near 90%. But what happens when the 401k isn't the only thing being manipulated? What if the very company the spouse works for is in on the scheme, offering deferred compensation or phantom stock options that don't show up on a standard retirement statement? We are moving from the 401k into the world of executive compensation and the hidden gold mines that many spouses don't even know exist. How do you split a wealth that is technically invisible? What if your spouse's true retirement isn't in their 401k, but in a secret agreement to receive millions in stock options the day after the divorce is finalized? And how do you prove the existence of a payout that hasn't happened yet? The next part is about the deep-sea fishing for executive assets and the multi-million-dollar traps hidden in the fine print of employment contracts. Deep-sea fishing for executive assets requires a shift in perspective from looking at what is in the bank to looking at what is written in the future. In 2026, the traditional 401k is often just the tip of the iceberg for high-earning professionals, particularly those in the C-suite or upper management. While a 401k is capped by IRS contribution limits, executive compensation packages are limited only by the imagination of corporate lawyers and compensation committees. This brings us to the world of non-qualified deferred compensation, or NQDC plans. These are essentially private agreements between an employer and an executive to pay out a portion of their current earnings at a future date, usually retirement. Imagine a character named Christopher, a vice president at a major pharmaceutical firm. His 401k statement shows a respectable $800,000. His spouse, Amanda, assumes that splitting this account represents the bulk of their retirement security. However, hidden in Christopher's employment contract is an NQDC plan that has been quietly accruing millions. Because these plans are not governed by ERISA, the federal law that mandates transparency and protections for standard 401ks, they do not appear on standard benefit summaries. They are often listed as general liabilities on the company's balance sheet. If Amanda's legal team only asks for 401k statements, they will completely miss the fact that Christopher has a $5 million future payout waiting for him the moment he leaves the company. The legal challenge here is that NQDC plans are not subject to QDROs. You cannot simply order the company to carve out a piece for the ex-spouse today. Instead, the court must use a combination of valuation and future interest mapping. Step by step, the discovery process involves a demand for the executive's complete compensation package, including the summary plan description for any non-qualified vehicles. In 2026, we see more attorneys using the constructive trust model here as well. The court may decree that when Christopher eventually receives his payout, he must turn over a specific percentage to Amanda. However, this carries a massive risk for Amanda. If the company goes bankrupt before Christopher retires, the NQDC plan is treated as an unsecured debt. Unlike a 401k, which is held in a protected trust, these executive assets could vanish entirely. Amanda would be left with a percentage of zero. Historical trends show a rise in what is known as phantom stock or restricted stock units, or RSUs. These are not shares of stock you own today. They are promises to give you shares after a certain amount of time, known as a vesting period. In 2026, the debate in American courtrooms centers on whether unvested RSUs are marital property. Imagine if Christopher was granted 10,000 RSUs 2 years into his marriage, but they don't vest for another 3 years, long after the divorce is finalized. Is that marital labor or future labor? Case studies in 2026 have popularized the Nelson formula and the Lynch formula, mathematical tools used to parse out exactly how many of those shares belong to the marriage. It's a fraction. The time from the grant of the stock to the date of separation, divided by the time from the grant to the date of vesting. But even with the formula, there is the tax trap. RSUs are taxed as ordinary income the moment they vest. If Amanda is awarded half the shares but Christopher is the one who has to pay the tax bill on the full amount, the math becomes a weapon. In 2026, sophisticated settlements include tax indemnification clauses where Amanda must provide Christopher with the funds to cover the tax liability on her portion of the shares, or the shares must be sold and the net proceeds divided. Then there is the issue of the golden handcuff. In 2026, companies are increasingly using retention bonuses that must be paid back if the employee leaves within a certain time frame. If Christopher receives a $200,000 bonus during the marriage and spends it on a family vacation and a new car, but then gets divorced and leaves his job, he might be forced to pay that $200,000 back to his employer. Is that a marital debt that Amanda should help pay? Or is it Christopher's personal liability because he chose to leave the job? These are the types of high-stakes arguments that can keep a divorce in litigation for years. The cultural shift we are seeing is that executives are becoming more creative in how they hide these assets. In 2026, we see cases of supplemental executive retirement plans, or SERPs, that are structured as life insurance policies. The cash value grows tax-deferred inside the policy, and the executive can borrow against it or take it as a lump sum later. Because it's technically an insurance product, it often bypasses the standard financial disclosures used in divorce. Forensic teams now have to look for premium payments coming out of the executive's bank account or list it as a taxable fringe benefit on their W-2. Imagine the scenario where an executive intentionally delays a promotion or a vesting date until after the divorce decree is signed. This is known as income manipulation. In 2026, courts are countering this by looking at historical trends of the executive's career. If Christopher has received a promotion every 3 years for a decade, but suddenly his career stagnates the moment Amanda files for divorce, the court may impute that future income to him. They can award Amanda a larger share of the current 401k to compensate for the fact that Christopher is clearly sandbagging his future earnings to lower his settlement obligations. Step by step, the valuation of these executive assets requires an expert who understands 2026 tax codes and corporate structures. They must calculate the present value of a future payout while accounting for the risk of forfeiture, the risk of company insolvency, and the inevitable tax bite. It is not uncommon for the expert fees alone in these cases to exceed $50,000. For the spouse who doesn't have the funds to hire these experts, the risk of leaving millions on the table is a reality of the modern legal system. But what happens when the assets aren't just invisible, but are actively being moved? In the next part, we're going to talk about the 401k and the world of offshore trusts and domestic asset protection trusts. We are moving from the corporate office to the high-security vaults of asset protection. What happens when your spouse moves their retirement funds into a jurisdiction where a U.S. judge has no power? What if the 401k was rolled over into an IRA and then moved into a Nevada asset protection trust just 6 months before the marriage ended? And how do you pierce a legal veil that was designed by the best asset protection attorneys in the country to be impenetrable? The fight for the 401k is about to get global, and the rules of engagement are being rewritten in real time. The transition from a standard 401k into a complex asset protection structure is one of the most sophisticated maneuvers in the 2026 financial landscape. To understand how this works, we have to look at the process of the rollover. When an employee leaves a job or reaches a certain age, they often have the right to move their 401k into an individual retirement account, or IRA. While the 401k was protected by federal ERISA law, the IRA is governed by state law. This is where the strategy of jurisdictional arbitrage begins. Imagine a character named Thomas. Thomas has built a $1.5 million retirement nest egg. Anticipating a divorce from his spouse, Rebecca, Thomas rolls his 401k into an IRA, and then immediately moves that IRA into a domestic asset protection trust, or DAPT, in a state like Nevada, South Dakota, or Cook Islands if he decides to go offshore. In Nevada, for example, the laws are specifically designed to protect trust assets from future creditors, and in some aggressive legal interpretations, this includes a soon-to-be ex-spouse. By the time Rebecca files for divorce in 2026, Thomas no longer technically owns the $1.5 million. The trust does. This creates a massive legal hurdle. A judge in Rebecca's home state may issue an order to divide the assets, but the trustee in Nevada, who is legally bound by Nevada law, may refuse to comply, stating that the trust is a separate legal entity not subject to the jurisdiction of a foreign state court. This leads to a high-stakes game of legal chess. Step by step, Rebecca's legal team must attempt to pierce the veil of the trust. This involves proving a fraudulent transfer. They must demonstrate that Thomas moved the money with the specific intent to hinder, delay, or defraud a creditor, in this case, his spouse. In 2026, the look-back periods for these transfers are a critical piece of data. Some states have a 2-year window, while others have moved toward even shorter durations to attract more trust business. If Thomas moved the money 3 years before the divorce was even a conversation, Rebecca might find herself facing an impenetrable wall. However, if the transfer happened 6 months before the filing, the forensic trail of intent is much easier to establish. Case studies from recent years show that courts are increasingly willing to use their contempt powers against the person, even if they cannot reach the trust. If a judge cannot force the Nevada trustee to release the funds, the judge can order Thomas to use other, non-protected assets to satisfy Rebecca's share. If Thomas claims he has no other assets, the court can find him in contempt, potentially leading to incarceration until the funds are made available. This is the ultimate showdown between the world of asset protection and the power of the family court. Beyond domestic trusts, we have to address the rise of the self-directed IRA, holding foreign real estate or private foreign businesses. In 2026, it is not uncommon for a high-net-worth individual to use their retirement funds to purchase a luxury rental property in a country with no extradition or reciprocal legal treaties with the United States. When the divorce happens, the 401k statement simply shows a share in an LLC. The true value of that LLC is tied to a villa in a jurisdiction where local authorities do not recognize U.S. court orders. The cost for Rebecca to hire local counsel in a foreign country, perform an international appraisal, and attempt to enforce a U.S. judgment can easily exceed the value of the asset itself. This is what we call a financial war of attrition. But there is a flip side to this cultural shift. We are also seeing the emergence of the collaborative 401k strategy. In 2026, not every divorce is a battle. A growing trend of mediation involves both parties acknowledging the tax inefficiency of fighting over retirement. Instead of spending $100,000 on forensic accountants and trust-piercing litigation, couples are using sophisticated software to model potential outcomes of different split scenarios. They might agree to keep the 401k intact for another 5 years to allow a specific investment to mature, using a private contract to dictate the future split. This requires a high level of trust, but the historical trend suggests that for middle-class families, the preservation of the principal is often more important than the immediate satisfaction of a clean break. We must also discuss the role of the 2026 tax environment. With the sunsetting of various tax provisions and the introduction of new brackets, the value of a traditional 401k versus a Roth 401k has never been more disparate. If Thomas has a traditional 401k and Rebecca has a Roth 401k of the same amount, they are not equal. Rebecca's money is tax-free upon withdrawal, while Thomas's money is essentially a joint account with the IRS. In a 2026 settlement, a savvy spouse will fight for the Roth assets every single time. Failing to understand the difference between pre-tax and post-tax retirement buckets is one of the most common ways people lose 30% of their wealth without even realizing it until years later. Step by step, if you are the spouse looking for these protected assets, you must demand a full accounting of all transfers out of retirement accounts for the last 7 years. You are looking for rollovers that don't land in a standard brokerage account. You are looking for wires to law firms in trust-friendly states. In 2026, the digital footprint of a trust setup is almost impossible to erase. Even if the money is in a secure vault, the path it took to get there is visible in the bank metadata. The psychological impact of this level of asset protection is profound. It turns a partnership into a target. We are seeing a cultural shift where younger couples, entering their first marriages in 2026, are demanding retirement-specific prenuptial agreements. They are no longer willing to leave their 401k to the whims of a state judge or the aggressive tactics of a future ex-spouse. They are treating their retirement accounts as separate sovereign territories from day one. This is changing the nature of marital trust, but it is also creating a more predictable financial future for individuals who have seen the carnage of the 401k divorces of their parents' generation. But even with the best trust and the best prenuptial agreement, there is one thing no one can control: the 401k plan's own internal rules. What happens when a plan administrator refuses to honor a trust because it violates the company's internal compliance policy? Or what happens when the 401k is tied to a company that is being investigated for fraud, freezing all assets for everyone, including the ex-spouse who was just awarded half? What if the money you fought for in court is suddenly locked in a federal freeze because of your ex-spouse's professional misconduct? And how does the Department of Labor get involved when a divorce starts to impact the stability of a company's entire retirement plan? We are entering the realm of federal intervention and the collapse of the 401k safety net. The final chapters of this masterclass will reveal the ultimate risks that no lawyer can protect you from. The intersection of federal oversight and marital dissolution creates a zone of legal turbulence that few anticipate until they are caught in the middle of it. In the United States in 2026, the Department of Labor and the IRS have intensified their scrutiny of ERISA-qualified plans, primarily to ensure that corporate misconduct doesn't swallow the retirement savings of millions. But for a couple in the middle of a divorce, this federal net can feel more like a trap. Imagine a character named Marcus. Marcus is a high-level executive at a fintech firm that is currently under federal investigation for securities fraud. Marcus has a 401k balance of $900,000. His spouse, Elena, has just been awarded $450,000 of that account in their divorce settlement. However, just as the QDRO is submitted for processing, the Department of Justice issues a freeze on all company-related retirement assets to preserve funds for potential victim restitution. In this scenario, Elena is now a collateral victim of Marcus's employer's alleged crimes. Even though the court has declared half that money is hers, she cannot touch it. The federal freeze overrides the state divorce decree. This is a crucial distinction in 2026. Federal law is the ultimate authority over retirement plans. Elena might spend years in a legal queue, waiting for the federal investigation to conclude before she can see a single dollar. Historical trends show that these freezes can last for half a decade or more. During this time, the assets are often moved into low-yield money market accounts to protect the principal, meaning Elena isn't just losing access to her money. She is losing years of potential compound growth in a 2026 bull market. Step by step, the reality of federal intervention involves a shift from family court to federal district court. Elena's attorneys must now file as interveners in a federal case just to protect her status as a non-culpable spouse. If the federal government successfully argues that the 401k contributions were made with the proceeds of fraud, the entire account could be subject to forfeiture. Case studies from the mid-2020s suggest that the innocent spouse defense is becoming harder to prove when the lifestyle of the couple was clearly supported by the executive's high-risk or illegal activities. Elena's claim to the 401k is essentially a claim against a pot of money that the government now views as stolen property. Now let's look at the systemic risk of the 401k safety net collapse from an administrative perspective. In 2026, we are seeing a massive consolidation of 401k plan providers. When a major provider goes through a chaotic merger or a technical failure, the processing of QDROs can grind to a halt. Imagine if Marcus's plan was managed by a firm that suffers a massive cyber attack. For months, no one can log in, no statements are issued, and no transfers are processed. In a divorce, timing is everything. If Elena was supposed to receive her share to pay off a bridge loan for her new house, and the system is down for 90 days, she faces a personal financial collapse. The plan administrator's liability in these cases is often limited by the fine print of the service agreement, leaving the individual to bear the brunt of the systemic failure. Furthermore, we must address the 2026 trend of the professional misconduct clawback. Many modern executive 401k plans now include clauses that allow a company to claw back employer contributions if the employee is found to have violated non-compete agreements or engaged in ethical breaches. If Marcus is fired for cause 6 months after the divorce is finalized, and the company claws back $200,000 from his 401k, does that come out of Marcus's remaining half? Or does it retroactively impact Elena's share? If the QDRO is already processed and the money moved to Elena's IRA, the company might actually sue Elena to recover the funds. This creates a state of perpetual financial insecurity where your retirement is tied to the behavior of an ex-spouse you no longer control. The cultural shift here is a move toward extreme financial vetting. In 2026, when someone is considering marriage, they aren't just looking at their partner's credit score. They are looking at the stability and ethics of their partner's employer. A 401k at a legacy company with a clean track record is worth significantly more in terms of risk-adjusted value than a larger 401k at a high-growth, high-regulation startup. We are seeing prenuptial agreements in 2026 that include indemnity clauses specifically for corporate misconduct, requiring the employee spouse to replenish any funds lost to federal freezes or company clawbacks from their separate property. Let's dive deeper into the IRS's role in the 401k divorce. In 2026, the IRS has launched automated compliance programs to track QDRO distributions. If the paperwork isn't perfect, the IRS may flag the transfer as a premature distribution rather than a tax-free rollover. This triggers an immediate 20% mandatory withholding and a 10% penalty. For a $450,000 transfer like Elena's, that's a $135,000 mistake. While it can theoretically be corrected through a series of complex filings, the immediate loss of liquidity can be devastating. Step by step, the only way to mitigate this is to ensure that the receiving IRA is established and the account numbers are verified by both the sending and receiving institutions before the transfer is initiated. Case studies also highlight the danger of the plan's valuation date. If the federal government intervenes and freezes an account, they often use a specific date for valuation. If the market crashes while the account is frozen, the participants are stuck with the lower value. However, if the market skyrockets, the government might only release the amount that was frozen, keeping the excess growth as part of the fine or restitution. This creates a heads, the government wins, tails, the citizen loses scenario that is becoming a major point of contention for 2026 legal scholars. We also have to consider the impact of inflation on these frozen assets. In 2026, if inflation is running at 5% and your $450,000 share is locked in a federal vault for 4 years, you haven't just lost the growth, you've lost 20% of your purchasing power. The 401k, which was supposed to be a hedge against the future, becomes a shrinking asset. This is why we see a trend of divorcing spouses in 2026 prioritizing the division of tangible assets, like real estate or gold, over retirement accounts when there is any whiff of corporate or federal instability. The psychological toll of this is a sense of betrayal by the system. People work for decades believing that the 401k is a sacred, untouchable account. The reality of 2026 is that it is a highly regulated, highly transparent, and highly vulnerable piece of the federal financial architecture. When a divorce forces that account into the light of the courtroom, all of those vulnerabilities are exposed at once. But as we reach the final part of this masterclass, we have to look at the ultimate question. After the lawyers are paid, after the federal government has had its say, and after the accounts are split, how do you actually rebuild? What are the historical trends of those who successfully navigate a 401k divorce versus those who fall into permanent poverty? And most importantly, what is the one strategy that allows some people to actually come out ahead by using the divorce as a catalyst for a complete financial rebirth? What if the 401k divorce isn't the end of your retirement, but the beginning of a much more sophisticated, much more protected version of your future? The final part will reveal the blueprints for the 2026 financial comeback and the secrets of the most resilient American retirees. Rebuilding after a 401k divorce in 2026 is not merely about replacing lost capital. It is about a total architectural redesign of your financial existence. Historically, many individuals view the 401k as a set-it-and-forget-it vessel. However, the post-divorce reality forces a confrontation with the math of time and the efficiency of every remaining dollar. To understand the blueprint of a successful comeback, we must look at the transition from defensive litigation to offensive wealth management. Imagine a character named Michael. After a contentious 2-year legal battle, Michael has seen his $1.2 million retirement account split down the middle. He is 54 years old, and for the first time in his adult life, he is solely responsible for a portfolio that has been cut in half. The first step in the 2026 comeback strategy is the tax-optimized catch-up. Because Michael is over 50, he is eligible for catch-up contributions, a provision in the tax code that allows older workers to funnel significantly more into their 401k and IRA than younger employees. But Michael doesn't just stop at the basic limit. In 2026, he utilizes a strategy often referred to as the mega backdoor Roth, if his employer's plan allows it. By making after-tax contributions to his 401k and then immediately converting them to a Roth IRA, Michael begins to shift his remaining wealth from a taxable bucket to a tax-free bucket. This is a critical pivot. He realizes that while he has less money than he did before the divorce, the quality of his dollars is increasing. A $600,000 Roth account may, in certain high-tax futures, provide more actual spending power than a $1 million traditional 401k. Case studies of resilient retirees in 2026 show a common thread: the diversification of income streams beyond the stock market. Michael decides that relying solely on a 401k left him vulnerable to the volatility of both the markets and the family court system. He begins to look at the historical trends of fractional real estate and private credit. By using a self-directed IRA, Michael can invest in assets that are not as easily liquidated or valued by a generic court-ordered spreadsheet. He is building a fortress that is both more resilient to inflation and less transparent to those who might seek to litigate against him in the future. Step by step, the rebuilding process also requires an aggressive audit of lifestyle expenses. In 2026, the rise of the solo economy has made it possible for professionals like Michael to consult on the side, funneling 100% of that side income into a solo 401k. This allows him to effectively double his annual contribution rate compared to his time as a standard W-2 employee. He is essentially compressing 10 years of retirement savings into a 5-year window. This isn't about working harder. It is about utilizing the specific 2026 tax structures that favor the independent contractor and the business owner. We must also address the psychological shift toward financial autonomy. The cultural shift we have discussed throughout this series concludes here. The realization that the only person truly invested in your retirement is you. Resilient retirees in 2026 are moving away from the joint everything model. Even if they choose to enter into new relationships or remarry, they do so with a rigorous adherence to separate property. We see a massive rise in the use of postnuptial agreements and segregated accounts. This isn't a sign of a lack of love. It is a sign of financial maturity. They have learned that the legal cost of a 401k divorce is often higher than the value of the assets lost, and they are unwilling to pay that price twice. Furthermore, consider the impact of the 2026 health-wealth connection. A significant portion of retirement savings in America is consumed by healthcare costs. Michael, as part of his comeback, prioritizes a health savings account, or HSA. In 2026, the HSA is the ultimate retirement tool. Contributions are tax-deductible, the growth is tax-free, and withdrawals for medical expenses are tax-free. If he doesn't use the money for healthcare, he can withdraw it for any reason after age 65, paying only ordinary income tax, similar to a traditional 401k. By maxing out his HSA, Michael is building a secondary retirement fund specifically designed to protect his 401k from being drained by the rising costs of late-life medical care. Historical trends indicate that those who fail to rebuild after a 401k divorce often fall into the trap of revenge spending or paralysis. They either try to maintain their pre-divorce lifestyle on half the income, or they become so afraid of the market that they move everything to cash, where inflation slowly erodes their remaining wealth. Michael avoids this by using automated investing. In 2026, AI-driven robo-advisors can perform tax loss harvesting and rebalancing at a frequency that no human could match. This ensures that every cent of Michael's remaining $600,000 is working with maximum efficiency. The data from 2026 suggests that the recovery period for a 401k divorce is roughly 7 to 10 years for those who follow a strict rebuilding protocol. This means that if Michael started his comeback at 54, by 64 he could potentially be back to his original net worth, albeit in a more tax-efficient and diversified form. This is the story that isn't told in the tabloids or the high-conflict divorce forums. It is the story of the quiet, disciplined reconstruction of a life. As we conclude this deep dive masterclass, we have to look at the broader picture. The 401k divorce is a symptom of a society in transition. We are moving from a world of collective stability to a world of individual responsibility. The 401k was never just a savings account. It was always a reflection of our cultural values, our belief in the future, our trust in our institutions, and our commitment to our partners. When those things fracture, the 401k fractures with them. But as Michael's journey shows, a fracture is not the same as a total collapse. The American retirement system, for all its flaws and complexities, still offers a pathway to security for those who understand the rules. The people who come out ahead in 2026 are those who stop viewing their 401k as a static number on a screen and start viewing it as a dynamic legal and financial entity. They are the ones who read the fine print, who hire the forensic experts, and who refuse to let a single signature define the rest of their lives. This has been part 10 of our masterclass on cultural shifts in 401k divorce in America. We have covered everything from the viral hook of the silver divorce to the deep-sea fishing for executive assets, and the federal interventions that can freeze your future. You now have the blueprint. You know the traps, the formulas, and the strategies for the comeback. But there is one final question that remains for the American public as we look toward the 2030s. As the traditional marriage continues to evolve and the 401k remains the primary pillar of our elderly security, are we headed toward a future where the 401k itself becomes obsolete, replaced by a new form of individualized social wealth? Or will the 401k divorce become so common that it triggers a complete overhaul of the American legal code? The conversation is just beginning, and in our next series, we will explore the radical proposals for the new American retirement and the end of the traditional asset split. What if the 401k you are fighting for today is about to be replaced by a government-mandated portable retirement account that follows you from birth to death, regardless of your marital status? The next evolution of American wealth is closer than you think.